Hey guys, on today's episode, we are going to take a quick look at three companies in the ad tech market. The ad tech market, I feel, is one in the past month has taken a huge beating. So I want to see if there's any fundamental changes in any of these companies. The first one we're going to take a quick look at is apps. This one's down 23.12% in the past month. We're going to take a quick look at Magnite. It's down about 21.8%. And we're going to take a quick look at Roku, which is down almost 18% in the past month. So all of them has definitely seen a nice pull down. And like I said, I just want to make sure nothing fundamentally has changed with these companies. If this is your first time here, guys, make sure to hit the thumbs up, make sure to hit the subscribe button, and let's get started. So like I mentioned, right, first is going to be Digital Turbine. This is ticker APPS, traded under the NASDAQ. Like I mentioned, down 23% in the past month. But we can see from its 52-week high, the stock has definitely seen better days. It's down about 48.6% right now. So apps just reported their earnings a few days ago on August 9th of 2021. They did announce about 104% year-over-year growth on pro forma revenue. This company is doing a lot of acquisitions, and overall their growth is kind of expanding because of that. But if we take a quick look at how their actual growth is, we can see in the past quarters this company has been a beast. In this most recent quarter, we don't look at pro forma values, it actually grew about 260%. Again, huge growth company, mainly because of nice amount of acquisitions. But we can see the past quarters, this company last quarter grew 141%. It grew 2 quarters ago 145. The one before that 116, and the one before that 93.15%. So for the past 5 quarters, this company has grown revenue by over 90% each quarter compared to the same time last year. So strong growth. Another thing I wanted to take a quick look at is see how these companies' margins are doing. Gross margins for this company is about 38.1%. If we take a quick look at trailing 12 months, those are some decent margins. And this company is kind of becoming profitable over time. Its profit margins are about 12.7. So right off the bat, I can see in trailing 12 months, nothing too hectic in forms of revenue growth, nothing too hectic in forms of gross margins and profit margins. So fundamentally, nothing has changed. Now I wanted to take a quick look at their balance sheet, see if their balance has kind of shifted over time. And I do see 2 things. First, if we take a look at quarterly, one thing is their intangible assets have grown dramatically this quarter. And we can see their overall non-current debt and payables has also increased in the form of liabilities this quarter. This tells me one thing, right? A lot of acquisitions have happened that are really increasing this company's overall debt and kind of increasing that intangible assets, right? So right now the company does have about $84 million in cash, and they have about $233 million of non-current debt. So I want to say the major fundamental changes all these acquisitions this company is doing is kind of dwindling its cash position and increasing its non-current debt. So if these acquisitions make sense, then overall it could definitely be a strong move for the company. But if they don't work out as intended, it kind of makes the company's balance sheet a bit weaker. The final thing I want to take a quick look at, and we're going to do this for all 3 companies, again, just checking the overall fundamentals of all of them. We can see revenue is increasing over time. If we take a quick look at trailing 12 months, right now revenue is hugely, again, that has to do with the help of all those acquisitions. One of my things I want to say, one of the yellow flags I see with apps right now, Digital Turbine, is their net cash flow from operations. Even though revenue is increasing, net cash flow from operations is actually going down. So not something I want to see. So something, investors, if you want to know more about it, this is definitely a yellow flag to start off right now. See why that is happening. The second stock but regardless, right, apps definitely look pretty good in form of fundamentals, strong growth, margins looked okay. Its balance sheet and its net cash flow from operations might do a little yellow flags. Whoops, I kind of messed up there. But if the overall business as a whole is still doing well, those acquisitions could be a huge opportunity for this company to continue to grow. The second company we're going to take a quick look at is Magnite. But before we go there, guys, let's take a quick listen to today's sponsor, a great reason why I'm able to provide so much content to you guys for free. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services The Fool offers. Through The Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. So Magnite, like I mentioned, is down 21.8% right now in the past month. But if we look from its 52-week high, the stock is down roughly 59.9%. Another ad tech market that's really kind of getting impacted right now. But let's start off. Let's see that growth, right? So overall, Magnite, another company we're going to see, is kind of also doing a few acquisitions here and there. Revenue this past quarter grew 170%. And the past 3 quarters, it grew 67. The one before that, it grew 69. And the one before that, it grew 62. So for the past 4 quarters, this company has grown its revenue by over 62%. The ones before that weren't as strong, so that's definitely something investors should keep an eye out. But the past 4 quarters were very strong in this company's return. If we take a quick look at trailing 12 months, gross margins are pretty high, 64.3%. This is a lot higher than apps. Apps was in the mid 30s in gross margins. If we take a look at profit margins, they are right now about 6.1%. So we can see different stages from apps. This one has higher gross margins, but it's still kind of in early stages of being profitable, where Digital Turbine is a little bit lower gross margins, but it has been profitable for many more quarters. Let's take a quick look at this balance sheet for Magnite right now. So Magnite, if we take a look at quarterly, what's happening? Very similar to apps, a lot of new acquisitions. So intangible assets have gone up dramatically. Again, that is all thanks to acquisitions. Because of those acquisition growth, this company has a lot more non-current debt, about $758 million. And they've also increased their payables liabilities. Right now, I do want to say very similar to apps, their balance sheet is not looking as strong because of these acquisitions. And these are yellow flags. Investors should keep an eye out. It doesn't mean it's necessarily bad. It's just say, hey, if these acquisitions don't make sense, it could go south. Right now, they have about $200 million in cash, $192 million to be exact. So they are a bit leveraged. Again, if the acquisitions make sense, not the biggest case, but investors should still keep an eye out. This, if we take a look at trailing 12 months, I am liking as revenue is kind of trending up. We also see net cash flow from operations trending up, unlike apps, which kind of gave us a form of the opposite. As one was going up, the other one was going down. So right now, Magnite doesn't really scream any major yellow flags, except very similar to apps. That balance sheet is kind of changing because of the overall acquisitions. Now, the final company we're going to take a quick look at is Roku. This is traded under the NASDAQ as ticker ROKU. We can see it's down about 18% in the past month, and from its 52-week high, the stock has definitely seen better days. It's down about 26.8%. So not as bad as these other players, but still might be giving investors some buying opportunities. If we take a look at this one, revenue growth has been strong for almost its entire life. We can see in the past 4 quarters alone, it has grown over 55% each quarters. So overall revenue growth, right from this chart, you can see it's been growing dramatically, and this is a strong company that doesn't seem like it's slowing down. So fundamentally looking good. If we take a look at trailing 12 months, this company has pretty high gross margins of 51.1%. They have about 9.9% of profit margins. So they are GAAP profitable, pretty impressive as well, and they are improving those GAAP profitabilities over time. I believe all 3 companies, if we take a look at adjusted EBITDA, will probably show stronger numbers, but here we're taking a look at GAAP profit margins. Now let's take a quick look at balance sheet at Roku, and we can see quarterly they have about $2 billion in cash, and right now I want to say they don't have much. I mean, they have about $421 million in non-current debt. So this company, unlike the other ones, is not leveraged. I'm really liking Roku. Again, they're all hitting different forms of ad tech or streaming markets, and all in different products, but this whole market as a whole has been kind of pulling down. So I wanted to see if there were any major yellow flags. In my opinion, I do like Roku a little bit more. They had consistently strong growth. They have been improving their overall margins, and they have a very, very strong balance sheet. The last thing I want to take a quick look at is this company's revenue and net cash flow from operations. So we do see as revenue is increasing, net cash flow from operations is also kind of increasing. So overall, fundamentally, Roku is probably my favorite at the moment. The last thing I wanted to take a quick look at is these companies' valuation. If we take a look at forward price to sales sales ratio. Roku is the most expensive, but remember, Roku is the one that has consistently been growing at crazy levels. It's consistently had positive cash flow from operations, and it has a stronger balance sheet. So it makes sense for this one to be the most expensive. Digital Turbine is sitting in apps is actually the cheapest, but remember, Digital Turbine also had the lowest gross margins out of the three. Magnite was the one in between with a little bit higher gross margins, was profitable. At the same time, I do want to say apps and Magnite probably had the worst balance sheets, so it's understandable why the prices are so different. But we can see they have definitely pulled down a nice amount from where they've been at in the past. So I hope you guys enjoyed this episode. I hope it shared some form of insight of how these companies are doing fundamentally. If you want me to do a full analysis on the full companies on any of these, feel free to let me know in the comments below. Take care, have a good night, and see you next time.